All right, let's jump right in. Welcome back to Noob Selling Options, everyone. We have a seriously exciting and honestly super detailed trade autopsy for you today. We're breaking down a massive real-time portfolio pivot. We're talking about liquidating a really comfortable consolidation play so we can aggressively catch a leveraged falling knife. It's all about risk, reward, and striking exactly when the institutional math aligns.
But hey, right before we get into the heavy math and look at the actual brokerage receipts, do me a huge favor and hit that like and subscribe button. Your support literally tells the algorithm that you want more of these transparent, data-driven trade breakdowns, and it really helps our Noob Selling Options community keep growing. So go ahead, click subscribe, and let's get into the explainer.
So here's the game plan for today. 1. Welcome to the pivot. 2. Why we sold SOFI. 3. The $1,000 Micron floor. 4. Executing the MU trade. And finally, 5. The risk-reward breakdown.
All right, let's kick things off with part 1. Welcome to the pivot. Moving right along to part 2, why we sold SOFI. Now, to make a really aggressive new play like this, we absolutely needed dry powder. That means understanding exactly why we're shifting capital around in such a volatile market. We really had to weigh the opportunity cost of holding SOFI versus buying into Micron. Look, SOFI is a high beta fintech. It's a solid company, but let's be real, it's highly vulnerable to broader market flushes, and it could easily take a fast trip down to 15 bucks. Micron, on the other hand, that's a dominant semiconductor player with a massive macroeconomic AI moat.
Look, the harsh reality with SOFI right now is just its vulnerability. Yeah, it's been sitting at a really well-established multi-month consolidation floor right around $18.44 to $18.50. You could basically get filled there all day long. But while it definitely has great asymmetric upside, it severely lacks the raw macroeconomic moat that a major AI infrastructure leader has. In a choppy summer market flush, SOFI could slice right through that $18.50 support and bleed all the way down toward $15. And why? Simply because it lacks the massive structural index tracking funds that are literally forced to buy its dips.
Which brings us to part 3, the $1,000 Micron floor.
So if SOFI doesn't offer us that cozy institutional safety net, where do we find it? Well, before we look at the Micron floor itself, we have to define the exact vehicle we are trading here. MUU. This is the Direxion Daily MU Bull 2X ETF. It's a leveraged product, and it's designed to amplify the daily price movements of the underlying Micron stock by exactly 2 times. If Micron goes up, MUU goes up twice as fast. But, remember, the inverse is absolutely true too. Following a pretty brutal 18.9% single-day decline, mostly driven by a tech-wide pullback, MUU closed right around $850.
And guys, this brilliantly illustrates the convergence math that makes this setup so compelling. Because MUU is a 2x leverage product, we can precisely map our entry target directly to the underlying stock. If MUU drops roughly 6% from its $850 close down to $800, that means the underlying Micron stock drops about 3% from its level of roughly $1,032. A 3% drop in Micron brings it perfectly, and I mean perfectly, to the $1,000 structural floor. $1,000. Seriously, it's an incredibly powerful number in the market right now. Let's actually break down why this specific price point is defended so fiercely by institutional buyers. First off, it's a massive round number psychological milestone. Second, it represents the exact level of Micron's early June consolidation. Third, and honestly, this is the big one, at $1,000, Micron's forward price-to-earnings ratio drops completely under 9x. That immediately pushes the stock straight into screaming strong buy territory for structural portfolios. Plus, it is fully supported by major players like Raymond James and HSBC, who recently bumped their price targets to over $1,100. Breaking below $1,000 would basically require a fundamental market break. Otherwise, institutions are kind of forced to defend it.
All right, part 4, executing the MU trade.
Armed with that high-conviction macro thesis, it's time to pull back the curtain and show you the actual receipts. If you look at the real-time order flow here, right in the middle you can see the catalyst, a completely settled transaction at $14.46, where we successfully sold 100 shares of SOFI at a limit of $18.40. Doing that exact move freed up the capital we needed to aggressively scale into the MUU dips you see surrounding it. Now, the crucial takeaway here is exactly how we stagger these entries. We didn't just dump all our cash at once. We capitalized on the downward flush at progressively lower entry points. We caught one share at $805, another at $791, and a third at a limit of $770. But you know what's really awesome about that third fill? We actually got positive slippage. It filled at $768.41, a full $1.59 better than our limit floor. That gives us a beautifully staggered average cost basis of $788.14 across 3 settled shares, well under our initial $800 target.
But hey, we aren't done yet. You'll probably notice we still have 2 pending limit orders working on the book, one at $730 and another all the way down at $695. Why do that? Well, by setting these deeper rungs, we are perfectly protected if the opening bell brings a sudden, high-volume stop-loss hunting spike downwards. If the market flushes and those hit, our overall average cost basis is going to drop like a stone into an incredibly high-conviction area. And if they don't hit, no worries, we've already locked in our core position under 800. Which finally brings us to part 5, the risk-reward breakdown. Let's bring this all together. This quote really summarizes our whole thesis for this play. Mu at $800 and below is a fundamentally stronger risk-reward play. You land a 2x leverage vehicle on a core AI infrastructure leader right at a premier structural support level. Basically, by letting the market do the hard work of shaking out the weak hands, we abandoned a vulnerable fintech play to align ourselves with real institutional order flow. If Micron holds that $1,000 floor and bounces, Mu's daily compounding is going to turbocharge that recovery. So that leaves me with one final question for you all. When the broader market panics and a premier structural floor is tested, are you going to be the one caught holding a vulnerable bag, or are you going to be the one stepping in right alongside the institutional algorithms? Let us know what your trading game plan is down in the comments below. And hey, if you found this deep dive helpful, please go ahead and like this explainer and subscribe to the Noob Selling Options channel so you never miss our next data-driven breakdown. Thanks so much for learning with me today, and I'll catch you in the next one.